you lose your voice. And we said, we're going all in on the individual, and we're going to build operations here. We're going to build scale. We're going to build our content, our marketing engine, everything, and create a digital lead generation. It wasn't popular internally at all. And we didn't know if it was going to work.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Really excited about today's interview. We have Michael Episcope of Origin Investments on the show. I've been following Origin a long time. They're one of the top private funds in the U.S. in my opinion, and been around a long time. I'm really excited to speak with you,
As am I, Jack. Thank you for having me.
So, you guys have been at this a long time, and you guys started in 2007 before the last crash, but I'd love to just take a step back and just kind of hear your story of how you got into the business, how you got into real estate, what you thought you would do, and how you got to where you are now.
Yeah, I sort of took a non-traditional route into real estate. I was born and raised in Chicago. I have a brief stint in Florida where I went to high school, came back here for college. And I got a summer job at the Chicago Mercantile Exchange between my freshman and sophomore years of college, and just decided I absolutely loved it. I was studying finance and econ. I always knew I wanted to be on the business side, I guess chasing money, if you will, a little bit on that side. And it was fascinating to me to be able to study finance and econ and, kind of watch how the economic indicators move the market on kind of a global scale. And at first I was down there, I had a job in the foreign currencies, and I worked there for a while. And I was just doing clerical work and running around, figuring it out, making connections, building my network. And ultimately I wound up in the interest rate quadrant in the Eurodollars, which was the largest trading floor or trading pit in the world when I got in there, and it grew even bigger. It was fascinating. It was dynamic. I was a clerk. I was a broker. I decided I didn't like that. And then I got a job with a hedge fund helping to manage their risk. And in the beginning, they were pretty slow. I started trading, and they gave me the green light. They're like, look, just if you're not doing anything, just trade and make some markets and things like that. And it turns out I was pretty good at it. And, in a very short order, my P&L actually outgrew the groups who I was supposedly managing the risk for. So I ultimately carved out my own deal with this hedge fund, was with them for another year. And they're still friends of mine. Like we ended it amicably, but ultimately I knew I didn't need their backing. I'd built my own capital base, went off of my own, bought a seat, and then traded for the next 7 or 8 years on my own. And it was a fantastic career. I loved it. I built, more wealth than I ever set out to or imagined to. And at that time, when I started, I was single. So I really had nothing to lose when you're going for it. I always tell people, you take risk when you're early, and there's really, if you don't have anything to risk, there's not a lot of risk to take. And so I did that. And but during the course of kind of the 10 years that I traded, I got married, I had kids, my wealth situation had changed, and I wanted to get out of the business because there were a couple things happening. Number one, my situation changed, and I couldn't take the same kind of risk because I had more to lose at that time. And then computers came into the market, and I always said, look, I'm not smart enough to know where the market is going, but I knew how to take advantage of the asymmetrical information flow, manage risk around my positions, and I was very, very good at that. And so I left that business in 2005, and the next stage of my life was really about how do I protect and grow my capital? How do I replace that income stream? I was too young. I was 35 to retire, and I wanted to be active. So I then went back and got a master's in real estate. And I was introduced to real estate as a youngster, kind of my, I would say, early teen years. I used to go work for my grandfather. He ran multifamily buildings on the west side of Chicago. If you know anything about Chicago, the West Side is not a good place. He bought these buildings out of tax sales, basically for free almost back in the day. But I saw the life that it afforded him and got to really understand the operation side of it. And so my partner and I got together. We had known each other from like 2002, 3. We were very like-minded, shared investment ideas, but we had the same desire to take control of our investment destiny. And every time we invested passively, it was sort of 2 steps forward, 1 step back. And we just looked at each other and said, look, let's just combine our capital. Like if this is the best the world has, like we can do better with our own money. And that was the beginning of Origin. And that, what I'll call ethos, really about creating an institutional platform for people like us, where we were finding good deals, had great deal flow, found edge, were allocating capital in a way that made sense across the different markets, had fair fees, good terms in the PPM as well. We're not financially engineering, we're building value from the ground up. All of that was sort of concepted in the beginning. But it wasn't like where we are today. Today we have 54 team members, 3,500 investment partners. We still use Origin as a place to manage our own capital, protect and grow. We're the largest investors at Origin. That has served us very well. We're also a top-decile manager. We've operated 8 funds to date, and we are only in multifamily. So I actually live in Chicago. We don't invest here. We invest in Sunbelt markets. And I'm proud of what we've been able to accomplish since '07. I can't believe it's already been 16 years. It's been a long road. And the biggest inflection point, to us was really around 2015, 16, when we were growing like a lot of other firms. We were only about 15 people at that time, and we were growing our fund business. And we were trying to go the institutional route because like everybody else, you want to raise big buckets of capital quickly. And our team wanted to, and our team was from those institutional backgrounds. And David and I, we weren't having a lot of luck because we didn't have the pedigree from those institutions. And that's really what they look for, because that's, when you bet on a guy who's from, the large institutions, it's sort of a, check the box kind of thing. Even though we had a great track record, a great team, checked all the other boxes, we just didn't have any luck. We said, look, we're not going to continue to straddle these two environments, trying to go after the institutional and the individual, because when you're going in 2 different directions and serving 2 very different customer bases, you lose your voice. And we said, we're going all in on the individual, and we're going to build operations here. We're going to build scale. We're going to build our content, our marketing engine, everything, and create a digital lead generation. It wasn't popular internally at all. And we didn't know if it was going to work. We were passionate about it. We thought it would. We had a great product. You put it in front of more people, and ultimately it should sell. And that's really, and I will tell you, give you some metrics here. At the end of 2015, we had about 95 investors, family offices, ultra high net worth. By the end of 2017, we had over 500. And so in those 2 years, we grew 5x, right? Today, we have 3,500. And so it's just grown exponentially as an organization. And the 2 reasons, there's a lot of reasons, but I would say the 2 things that we obsess over are returns and client service. And as an investor myself, I understand that you have to hit on both those sides. You can't be a black box. So it's really important to communicate, to educate, to set expectations, and then deliver on what you say you're going to do, and always be transparent about the way you operate as an organization. And those are the 2 pillars that have really, we've always lived by, and is one of the reasons why we've excelled in this market.
That's a great story. Thank you so much for that. I'm curious about just managing operations and scaling. I mean, I'm in 40 deals as an LP or co-GP, and it seems daunting, and we have obviously a lot less staff. But are you guys vertically integrated on some of your deals? Do you have a number of kind of just long-term operational partners where they're doing the property management, where you guys have kind of seat at the table? Like how's the structure for the operations at the scale you're at?
Yeah, I think of operations in 2 different arenas. One is at the company level operations, and managing 3,500 investors. You can imagine how that has its own set of challenges. And then managing, we have 3,500 units under management. We've got at least a pipeline that big under development right now, and we've got a lot of preferred equity that we manage. And so we have different teams that do this, but certainly when you're in growth mode and all of a sudden your growth hits these inflection points, you have to build the plane while flying it, right? You're always thinking about this, how to stay ahead of this. Hiring the right people is key. So I'll take you through, a couple of our operations. We have an investor relations team that is 8 people strong, all right, in our organization. And half that team is dedicated to the individual, the high net worth, the family office. Half that team is dedicated towards the wealth management space. And then we have an investor services group that handles all of the data, the information, our technology, the portal, customer inquiries on that side. And that's also handled a lot with our investor relations side. But we have people who are, their whole job is doing nothing but reporting, collecting data, making sure that we have accurate information. That team is ultimately then interfacing with our asset management team. And the asset management team, which also blends into our investment management team, is the one responsible for executing the business plans on all of our deals. And that team is about 9 people strong. And we have construction experts, we have development experts, we have financial experts, we have operational experts, property level experts as well, on that team. And so they are the ones overseeing all the property. And a lot of that is enhanced with technology that we bring in-house so that we can see data in real time. And it's important to us, especially because the majority of our operations and our mothership is in Chicago. But when you have property everywhere, in today's day and age, it's actually very easy to get real-time information on the things that matter. And for example, reputation management, we do a lot on that side. And all that means is that you're making sure that your reviews are constantly being evaluated, being monitored, being asked for. And our team, when they sit in the office in Chicago, every one of our properties, they come in the morning and they see all of the reviews that happen overnight. And they have a playbook that's about 70 pages long. I should say we don't property manage. There's a very good reason for that. It's low margin, high people. We're in too many markets. We can't look people in the eye and say, look, we're best at this, 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 and this, right? You can't be the best at everything, so you have to choose. But I think our asset management team does an amazing job implementing this playbook to every property management group who they hire. And we're pulling the strings on this. In fact, we just got an award recently. I think it was, I forget the name of the publication, but we were ranked the number 3 out of 68 operators. And we benchmark everything to the competition. So we are the ones holding the property manager's feet to the fire, because you have to understand, like, if you're working in a vacuum and your rents go up 20% and your manager is telling you that, you might be like, great, but how do you know they shouldn't have gone up 30%, right? The only way you can know that is you benchmark it against the competition. And if we have to make a change at the property management level, we will. But there's also, there's pros and cons of being in property management, but we never wanted to think about this ancillary business that was driving fees to the organization that would be potentially the tail wagging the dog as well. So I in that regards, I really love our model. I wouldn't change it. We absolutely have the ability to go into property management, but we're not going to do that. So I think today our organization has never been running better on all levels. And it really comes down to the people who you hire, at the helm to run the operations, and making sure that they're executing the right playbook, that they have the right processes, that we're doing the right things. And I couldn't be more proud of our team and how they've been able to execute on in every division.
That's awesome. Thank you so much for that. I want to talk about the economy a little bit. And I didn't realize you had such an economics background as well. What's maybe walk me through the last few years of your strategy, as far as interest rates. Interest rates were at 0 for a few years. Yeah. Actually, even through COVID, I'd be curious to kind of, the tumultuous couple of years. Would love to just sort of understand maybe some key deals and sort of key pivots you guys have made over the last couple of years as between COVID and interest rate increases.
Yeah, I'll give you the backdrop, because I think one of the big advantages of our strategy is that we work up and down the capital structure, meaning we will invest in common equity and also preferred equity. So we're in the credit, and then we can invest across different strategies as well. We can do ground up development, we can do value add, originate loans on that side. And going into COVID, we actually bought a deal. We had a deal tied up from February of 2020, closed it in March. It couldn't have been worse. The world's sliding off a cliff at that time. It turned out to be good, but when you close a deal on March 5th and then the world shuts down on March 17th, that doesn't feel too good. But at that time, 2020 was a year, we as an organization shut down. We said, look, we don't know how to price anything right now. The whole global economy shut down. Everybody's upstairs in their home office. It would be irresponsible for us to continue to put money into anything at that time. We killed deals. We had a pipeline of $250 million of deals, killed them all, right? And when you go into late 2020, that's when we made the decision, look, there's probably an opportunity here to go into the credit side because we want to protect ourselves. And that's what we did. And we started issuing a lot of preferred equity at that time, filling that gap. We thought the market was too volatile to go into the value add space. And really, it was even before that. We hadn't done a lot of value add because we started to see the relationship between existing property values and where you could build for. And that gap only widened during COVID. And you don't have to be a genius in this market, but there are certain relationships that will always hold true. And so going into 2021, when we started to see that disparity between what you could build for and where existing properties were trading for, the gap kept getting bigger and bigger and bigger. So we ended up really looking at this from a barbell approach. We were doing ground up development and we were doing preferred equity, but we didn't buy a single value add deal. We didn't buy a single stabilized deal, nothing on the core plus side. In fact, in our legacy funds 2 and 3, we sold about $500 million worth of property between the beginning of 2021 and I'd say the end of first quarter 2022 using that strength. And so that to us really helped a lot during that period, but it should intuitively make sense if you as a manager and you have the ability to go into all these different strategies and you're looking at the returns, right? And returns, when you find yourself where there's asymmetrical returns to the downside, you walk away, you just don't do it. And that's what we saw. We said, look, if we can build for $300,000 per unit or buy for $400,000 per unit, we'd way rather build. And if the market goes to $500,000 per unit, that's great. You can go back and look at all our webinars going back 2 years. This was the thesis we had. And lo and behold, but the other side of that coin, our job is to protect and grow the capital of our investors. They're already wealthy. And if the market goes from 400,000 down to 325, well, guess what? We just haven't made as much. We didn't lose money, but if you bought an asset at $400,000, you're losing your shirt, especially when you think about leverage on top of that. And that's how the market played out. So we defensively positioned ourselves into really high quality ground up development in growth markets and the preferred equity side. So in fact, in our Income Plus fund, we actually posted over a 10% return last year in honestly one of the most abysmal markets I've seen in a long time. And that's after writing down a significant amount of our kind of stabilized assets by call it around 15%. But what made up for it on the other side was not only our preferred equity, but also our ground up development. Now, ground up development, when you are looking at developing to a 35 to 40% margin and the world changes and suddenly comes down 20%, you haven't lost money on your ground up development, but instead of making a 40% margin, maybe now you're making a 10 to 20% margin on that asset. And that's the difference. And that's why we were able to still generate positive returns in this environment. Would we have loved interest rates to stay where they were? Certainly. The other thing that we did is we proactively hedged interest rates going back to late 2021, and we engaged in a product called swaptions. And this really goes back to our trading backgrounds, but it's something that we entered into with the banks. And what a swaption is, it's an interest rate contract based on the 10-year. And when you don't have loans in place, you can't do swaps. So you have to use swaptions to hedge the interest rate on your portfolio. So we ended up paying about $15 million for swaptions across our various portfolios. And we made about a $43 million profit. So some of those are still on, but we hedged a significant amount of risk during that period. Now, truth be told, we would have rather lost that $15 million and seen interest rates where they were at that time, but but the hedge worked. Did it completely offset all the valuation moves? Absolutely not. But it definitely gave us a war chest to pay higher rates on a lot of our properties that are now being refinanced today and where we're locking in permanent financing.
That is fascinating. What size and scale do you have to be to do that? We have a fair amount of operators and syndicators that are likely listening. And I know on an individual loan, you pretty much have to buy an interest rate cap, but is that something you need to be in 10 million plus to buy something through an investment bank, or can someone do that for?
No, yeah, it's a good question. I mean, you got to be well over $1 million. If you have enough, it depends on where your risk, right? The way we view the world is you have all this exogenous risk, things that you can't control. And for that you can't control, you try to look for ways to hedge it, right? Or you always ask the what if scenario. And if you have enough margin, you might say, look, all I'm doing is giving away some margin, but I'm not going to lose my equity in these situations. And so you're always, trying to protect that downside risk, protect capital. The way we make money is by making money for other people and making sure we stay in the game past cycles like this. And you get to the other side, and if you can do a good job, more money will come your way. And I would say for swaptions, we entered into a lot of different contracts with different banks. Some of them were as small as $2 million. And it worked on that side. We have a little bit of a hedge on today left. We took some off when the 10-year was a little bit higher. So we took a little bit of bet that the 10-year was done running at that time. My philosophy now is that the Fed is going to put us into a recession, that we are going to see the 10-year hit a 2 handle over the next kind of 6 months. I think that the banking crisis has done their job for them. I don't think they needed to do this last 25 basis point move, although I don't think it matters one way or the other. But there's never been a point in time in the history of the United States where we've had a recession and the 10-year hasn't come down by at least 150 basis points. And you are starting to see better information about inflation, and we feel it on the ground too. We've seen construction prices slow down. You've seen energy prices cool off. You've seen housing prices cool off, especially on the rental side. So I think it's only a matter of time, because if you understand the math behind how inflation is actually calculated, it will run its course where prices will reach a certain level and just stay there. They may not come down, but I think, by the end of this summer, we're going to see some really good inflation numbers and probably see the 10-year below 3% again, and everybody's going to be reaching for yield.
That would be amazing news for myself and our investors. We play in a little bit less institutional realm than you. We're in a lot of class B or C plus value add deals. And, we have a fair amount of fixed rate debt, but we're in some deals with bridge loans. And I know most of the stress I hear from any investors I talk to are regarding, the syndications that have bridge debt. Most of them, almost all of them have, at least our deals have interest rate caps in play, but those caps expire. And, really kind of white knuckling a little bit on sort of where rates are when these deals need to sell or refi. But love to hear your take on kind of the class B value add market and sort of where cap rates may go, kind of depending on interest rates and what Origin's strategy may be if you're going to re-enter that market, or stay with the new construction in the more of a class A asset base. Yeah,
look, it's not really my expertise, the class B value add. We haven't looked at it in a long time. I have an opinion here, and I would say it's very much like the new car, used car phenomena. There's only the reason why we got out of the value add space to begin with is we were looking at 10, 15, 20-year-old property trade close to replacement cost. Those they can't exist, right? Ultimately, the fundamentals prevail, and the Class A property has to trade at a significant premium to the Class B or Class C property. In the last few years, because of the lack of housing, the lack of or the insane demand we've had for housing as well, the shortage here, you've just seen the market turn upside down, and it was classic. I mean, when I went to buy a car for my son, I just couldn't believe it. This is like a year and a half ago, and used cars were trading more than new cars. And I'm like, oh my God, we'll just wait 8 or 9 months. And ultimately, we know what happened with the used car market crashed. And I do think that you're going to see the Class B and Class A, that differential widen. And whether that means Class A is going to go up or Class B goes down or a little bit of both. But that's kind of how I view the world in those things. In those world, I think Class B is probably a little overbought right now, but it's where the majority of demand, and affordability is a huge issue in all of these markets. So I could be very wrong on that side too.
Gotcha. And you mentioned, you mentioned the 10-year coming down because of the recession, potentially, whether it's a soft landing or hard landing. What about just higher level macro? I know that the average baby boomer turned 65 this year. I just saw a quote, and hearing about a lot of money coming out of equities into bonds. Is that something also you think may have pressure on interest rates, or is it not going to move the needle?
I'm not sure how that demographic movement impacts interest rates on that side. Certainly, when you have this huge cohort that is they're dependent on savings and rates and replacing that income, you have to see money flow into there. And the amount of cash on the sidelines today is at a record, and people they don't really know how to invest. They know they should be investing, but candidly, getting 5% of the bank feels really, really good. I just don't think that's going to last that long. Since you brought it up, though, I will tell you one area that we're really excited about and doing a lot of work on is active adult. And active adult sort of, it overlaps into traditional multifamily. So you don't have food service, you don't have any healthcare in active adult. These are generally age-restricted multifamily properties that have services, right, to make it fun, make it exciting. And that, I think, is going to be a huge booming sector over the next 5, 10, 20 years. And even though it might be 55, as you see the boomers going in there, the average age is about 70, 75 in these active adult communities. And there's a huge off the charts demand in that. And actually, what I'm more concerned about today is really traditional multifamily, because the millennials are aging out of multifamily. And as much as we want to say that they're going to rent longer, maybe, yes, and they're kind of priced out of maybe some home buying, ultimately they're going to buy a home. They're going to have families. They're going to move to suburbs, right? This has happened for a while, and there's a ton of baby boomers who are going to be fleeing traditional multifamily, and the cohort behind them just isn't nearly as big. I think it's about 10 million people lighter. So we have to be, careful about what we're building and how we're building these things. We really favor in today's world, build for rent, which is horizontal multifamily, not quite like single family rental. These are purpose built. They have your fitness, they have your amenities like your fitness centers, your clubhouses, your centralized leasing, and it's a single community, but it's a build for rent, not for sale in those. But you get that single family feel and still the flexibility. And I think that's where the market is going. But that segment of the market, built for rent, only accounts for about 6% of the overall market, but growing significantly.
Yeah, that's a fascinating market. I'm tracking, there's a few sponsors that have put deals in front of us there. And, I had a period of time where I worked on Wall Street myself in the non-performing loan space. And a lot of those funds also, dabbled in a few asset classes. But I'm fascinated with the private equity and the hedge fund buyers in that market, and how, sometimes they're pricing to a cap rate and they don't even care about comps. They'll pay 20% over what the comparable square foot single family house would trade for, because it meets their model. Is that an area? I mean, is your exit strategy to kind of build and hold, or do you have scenarios where you could build and essentially have a built-in takeout to a fund?
My strategy is to buy from those guys who buy things that, off a spreadsheet eventually. We saw what happened to Zillow. Real estate is way more than a spreadsheet. It's an art and a science, and you have to understand, yes, the math behind it and discounted cash flow, but you also have to understand the bricks and sticks of real estate and what really makes it tick. So, when I hear, like the Wall Street guys trying to buy single family homes off spreadsheets, I just kind of chuckle. It just doesn't work, right? Not in scale of that. People have done it, and if you have a market that's going up, you're always going to be let out of your mistakes. But we have a team out there. We have 5 offices total. One of them is Chicago. We don't invest here. We're in Sunbelt markets, and our team does a fantastic job of just unearthing really unique opportunities. And yes, everything we do goes into our fund. So we have a credit fund that's primarily focused on delivering yield to the investor. We have a multi-strategy fund that is what we call our all-weather fund. So it incorporates all of our strategies. We have credit, we have ground-up development, and then we have a core plus component in that fund. And then we also have a qualified opportunity zone fund. And if we see if we see distress happening in the market, we will absolutely raise our 5th growth fund. But today the market is kind of we don't really see distress, but Our previous growth fund was all ground up development. We also don't see the market kind of ripe for ground up development. So we're waiting on that. And that could be, if we honestly see some amazing opportunities out there and the market really starts to see some of those 2021 vintage properties being sold off and go into distress, then we'll raise a fund for that. But we don't want to speculate on what's going to happen in the market. If it starts happening, we can raise capital quick enough to take advantage of situations like that. And since I'm on the subject, like 2021 is a really interesting year. I was just reading the other day that that vintage, they're lumping it all together. There's probably a big difference between Q1 and Q4. But the average loan of properties bought in that vintage in multifamily is already somewhere between 90 to 95% loan to value. And this market over the next couple of years, we always joke, everybody used to do the cash out refinance. Now there's going to be a term that nobody's ever heard, which is called the cash in refinance. And sponsors are going to have to come to the table with 10, 20, 30, 40, $50 million in some cases when they go to refinance, because you've got a higher debt cost, but then you also have banks that have retrenched and they're not going to be lending anywhere near 65 or 70. So if you bought a deal in 2021, you used preferred equity, high leverage, first of all, your equity is gone. If you did a ground up development deal during that time, chances are a lot of your margin has disappeared. And then when you go to refi, you're still going to have some value creation there, but you're likely going to have to pay the bank down 10, 20, $30 million. And so we view that as a huge opportunity. And the reason I'll say it's an opportunity is because you have this capital markets issue. You also have a wall of supply coming, but you also have really good long-term fundamentals. If we were talking about office right now, couldn't say the same thing. And so when you have a temporary dislocation in an otherwise healthy asset class, that's an opportunity. If you have an unhealthy asset class, then you're just guessing and it's a falling knife that you might be catching. But we see the next 6, 12, 18 months as an amazing opportunity for investment in multifamily real estate, especially on the credit side and hopefully on some of the value added and existing side, and being more of an opportunistic and sniper on that side.
Gotcha. And then for those sponsors that may be in that situation where it's a cash in refi and maybe it was a syndication, kind of a mom and pop syndication where they're not really, capital call is not the ideal scenario. Should those sponsors be reaching out to someone on your acquisitions team where you guys may be able to I don't want to say bail them out, but maybe partner and dilute, but still have a potential win-win situation where you get a quality asset and help streamline the capital stack?
Yeah. As long as we're very disciplined about investing in our markets. We want to be so we're in the Sun Belt. Anybody can go to our website and kind of see where we invest and what types of properties. Generally, we're going to be in the tier 1, tier 2 sponsor class, so the upper tiers on that side, and we're going to be in more institutional quality assets. So we don't think about these. When we're out there providing preferred equity, we're not your traditional lender. We think about this as an owner of equity, and that's just the way we view the world. We've never lost money on the equity side in multifamily because of the way we view risk, we view the sponsor, we view capital structure, we view business plans. So a bank or maybe another traditional preferred equity provider would be better suited than us for assets or sponsors that don't really fit that criteria. But we'll absolutely give a quick answer, and that's our job, is to evaluate or send people in the right direction. And there's a lot of, the good news is there's a lot of cash out there being raised for this gap equity, this rescue equity, this preferred equity. And if you can survive through this and get to the other side, then you might have some equity, coming back in 25, 26, 27, around those times, right? No, every business plan, it's never a straight line, right? Success is never linear. You take twists and turns and things like that. And 2021 was just a bad vintage year.
Yeah. It's trying to think of our most challenged deals was I think January. Actually closed in January 2022, right before the rates, right before the rates moved. Those are
yeah. I mean, look, we closed the deal. You don't know, right? You make the best decisions at the moment in time, and the world can change quickly, and there's only so much so much risk you can manage against in those situations. But I always tell people, look, any business model should be able to withstand 2-3 standard deviation moves. But when they start moving to 4 or 5 standard deviation moves, it's kind of, you're off the rails a little bit in that case. And I remember I got a question, we were doing a roundtable and I got a question from an investor. He said, well, what happens, and this is when, by the way, rates were 2%. And he said, well, what happens if rates go to 9%? I said, well, I hope you have gold in your portfolio. Because candidly, people ask this, what they want to know is, how do I lose money, right? And my answer was, look, nothing is going to work. If interest rates move to 9%, look out below in the S&P 500, look out below in the U.S. economy, because we would be defaulting on government debt. So yes, you get to a point where nothing is sustainable. And if you believe that there's a chance that rates are going to 9%, then load up on gold and maybe Bitcoin or something like that, but don't invest in real estate, But I'm not, again, smart enough to know where the world is going to be in a year. I've been around long enough to know that these crystal ball, like these soothsayers, nobody knows anything about where the market's going to be. Even if you know what's going to happen in the economy, the ironic thing is you don't know what's going to happen in the investment sector. And it could be that the economy goes into a recession and then the stock market actually goes up 10%. And so it follows like a really weird pattern sometimes, and you don't know, right? Sometimes having too much information can go against you.
Yeah. I go through those doomsday phases of what happens when rates go to 9%. And I was talking to one of our sponsors, and he goes, if rates are at 9%, what do you think inflation is doing? And he goes, you can't really model 9% interest rates without at least significant inflation, probably inflation of rents. But completely agree with the sentiment. The U.S. GDP, 120% debt to GDP right now, whereas the 80s it was 20 or 30%. So.
Yeah, I mean, certainly. And I'm a pessimist. The Fed's going to get this under control. The United States government can't afford short-term or long-term rates on this. The duration on government bonds is or government debt right now is super short, and they're feeling a lot of pain. So they want to really get this down more than anybody. So I think we are on the right side of the equation, and we'll get through to the other side, and we're in great asset class.
Yeah, and I know obviously it's going to be very market dependent, but when you're looking at exit cap rates in this time frame, and you've got such a difference between SOFR and then say the 10-year, are you modeling sort of a cap rate off of the current 10-year, or maybe that the 10-year will be dropping, like you mentioned, and adding spread? Like how do you guys look at your exit risk without the crystal ball?
Well, I think this just comes down to institutional standards, and we don't guess. One thing that has saved us over the years is that we always underwrite to higher cap rates in the future. And again, back to things that you can't control, you don't know. You have to provide buffers to these. So I can tell you that's what I think the 10-year is doing. That doesn't show up in our underwriting. There could be other people at Origin who think the opposite. But what we do agree on is that best practice is you take the spot cap rate and you drift it over time. And if we believe, if we can agree that the spot cap rate today on truly institutional quality real estate in secondary markets is a 4.5% cap rate, we will drift that basically by about 10 basis points per year. So if your exit is in 5 years, you're exiting at a 5% cap rate. That is a buffer, but when you're looking at underwriting, there's 100 different variables that can move the needle in different directions. And where'd you go, Jack? Jack's gone, but we're still recording, so I'll just continue on here. You have a lot of different variables that can move the needle, and one of them that's really moving the needle today is insurance and taxes, and these are the parts of the equation that are going up significantly that maybe people weren't thinking about today. So cap rate is the great multiplier on income, but the other thing is the expense side of the equation, and so you have. Like in Florida right now, in Texas, we used to underwrite insurance on a per unit basis of $700-800 per unit. We are now getting back quotes from insurance companies at $2,200, $2,300, $2,400 per unit. So cap rates are one place of risk, but so are your expenses, so are your rents, because ultimately your cap rates are going to multiply your NOI, and the NOI is made up of both your revenue and expenses. And within those, you've got hundreds of variables. So it doesn't just come down to one thing. It's also like we look at cap rates and then price per pound. We look at it from a rental. We do comparables. We always want to make sure that we have more meat on the bone and that we're underwriting conservatively. If we can make a deal work with rents that are $1,800 per unit and the market's trading at $1,900, we're not going to show something, just to show it. Oh, hey, look, we're going to make a 2.5x on this. We'd rather show, that we're going to double our money and then perform at 2.5x with some downside protection on that. So it's there's so much complexity that goes into underwriting and managing risk around this stuff, and it's about triangulating good value in the right markets.
Great answer. And I know we may have had a couple seconds of my internet connection drop for a few seconds, so hopefully that all came through.
Yeah, you were fine. I just kept going. I acknowledged it. I said, well, Jack left, so I'm just going to keep going. So.
What type of advice do you have for passive investors, especially, I was shocked at how many people are accredited, maybe have even $5 to $10 million net worth that don't have any investments outside of that traditional stocks and bonds. So, for someone who's looking to get more into alternatives, as someone who's done it themselves to grand scales, what type of advice do you have?
Yeah, I think it's a huge mistake not to be in alternatives. I've been in alternatives even before I started Origin. I think there's a whole world out there, and you have to educate yourself. And, in times like this, I don't believe that the stock market is an efficient place to invest. I don't like it personally. I don't like the fact that in one, if you go back to 2021, you had companies trading at 30 times revenue. And today, those same companies are trading for less than cash on the books. We follow the public REIT markets quite a bit. The public REITs are a great investment, especially now. They're actually trading at a discount to the net asset value of their assets, but they trade at a premium. And real estate doesn't move that much in terms of value. Certainly, we've seen it come down a lot in the last year and a half. But the public markets, those REITs have come down 60, 70, 80%. Just hasn't moved that much. And so real estate as an asset class, if you think about it, it's somewhere between a hybrid between a bond and a stock, and it has that kind of risk, and that's really where it belongs in the portfolio. The interesting thing, though, is when you look at real estate kind of on an aggregate, it's actually outperformed the S&P 500 over the last 10, 20, 30, 40 years, and that's what you're looking for in a portfolio. You're looking for something with low correlation to the assets that you already have, something that's complementary, something that produces cash flow, tax efficiency, and upside, an absolute return. And real estate, especially the multifamily side, which is why we've chosen that, it's, I don't want to say a unicorn, but it's almost like a unicorn for a portfolio. It violates the premise of the efficient market theory that if the risk is between bonds and stock, then the return should be there. And in fact, that hasn't been the case. It's generated higher absolute returns with lower volatility. And whether you invest with us or somebody else, it's about how you invest, though, and who you invest with that ultimately matters. But you have to pick your head up. You have to educate yourself. If you have a wealth manager, lean on them. I think it's a mistake for wealth managers to not have a stable of good alternatives that they're offering their clients as well. The 60-40 portfolio, that anybody can do that. I can do that myself. You can go to Schwab. That's just that's not adding a lot of value. The alpha is found in the alternative side.
Absolutely. I'll just quickly add the tax side of it too. You mentioned REITs, and if you're a high earner, I think REITs are still taxed at 29% even after the small discount. Versus, I assume your funds, at least some of them, at least, are shooting off K1 losses with positive cash flow as well. So you could have a tax deferred income.
Yes, everything we run, because our investor base is homogenous, all taxable. We're taxable. We think a lot about tax efficiency. And I don't know if I said this already, Jack, but we really moved away from the private equity model of real estate where it's buy, fix, sell, and more into a buy, fix, and hold. Because if you're not taking advantage of the cash flow that real estate provides and the depreciation, which produces tax-free cash flow, and the ability to refinance tax-free, you're just not getting the benefits. And real estate has true structural advantages over other asset classes. And so this has been an evolution for us. But what we realized, we're like, look, hey, we just sold an incredible asset that was cash flowing great. And now we've got to pay all these taxes. And now we're sitting in cash and blah, blah, And you look at the drag and you can actually take less risk and make a lot more money. And too many people chase IRR and don't consider the impact of how that impacts long-term wealth creation, when really you have to look at where, IRR is important in some metrics, but what's more important is multiple on invested equity. And we all know that the person who bought a piece of real estate 25 years ago for $10,000 that's worth, $2.5–3 million. That's how you build wealth, is you buy great assets, you build value, and you hold forever and minimize taxes across any asset class. You don't trade in and out of these things, right? Uncle Sam loves that strategy.
That's very, very well put. Well, we're coming up. We're running out of time here. Please tell everyone how they can get a hold of the Origin Investments team, and if you have any closing thoughts, certainly give the floor to you.
Great. It's really easy to connect with us. Go to our website, origininvestments.com. We make it, you can download our investment deck there. You can reach somebody in IR. You can also email us at investorrelations@origininvestments.com. It's kind of long. But we'd love to talk to our investors, and please reach out to us. That's great. And no real closing thoughts. I thought this was a great dialogue. Thank you so much for having me on the show.
Yeah, it's a real pleasure and honor. I followed you guys for a long time, and you provided a ton of great content for our audience. So, really appreciate it, and hopefully I can run into you at a future event.
Well, if I'm down in Puerto Rico, I'll definitely look you up, Jack. Thank you.
Sounds great. All right, everyone. Thanks again for listening to the episode. Please subscribe on iTunes, Spotify, YouTube, and leave us a 5-star review. And we'll see you on the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there, all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.